Alright, welcome back. Today we are taking a deeper dive into futures contracts and also talking about leverage, which is a super important concept in trading futures. So today we'll look at three of the most popular futures contracts: ES, NQ, and GC. ES is the futures of the S&P 500, NQ is the futures of NASDAQ 100, and GC is the futures of price of gold, essentially. And they all have different leverages um, per point, meaning that ES, for every point moved on the ES futures market, it is worth $50 with one ES contract. NQ is worth $20 for every point moved on the NQ chart, and gold, same thing, but $100. So let's hop on the chart and take a look at what that actually looks like. So the market is closed right now. Otherwise, I would take a trade on my demo account just to show you. But just to give you a visual, I'm on ES right now. And if I had one contract of ES, which is worth $50 per point, and say I took a long position right here, and I hit take profit at 2 points, which is my target, that would be worth $100 right here. 2 points, $50 per point, $100. On NQ, if I took a trade right here, took a long position, and hit TP at $20 or 20 points, it is $20 per point, which means that this would be a $400 trade right here. And let's take a look at GC as well. Same thing. If I were to take a long position right here and hit take profit at 2 points right here, that would be worth $200 because it's $100 per point. Now, that might not look like a lot here, but it is, because in the greater movements of the market, higher leverage can be pretty dangerous for retail traders, especially if we have smaller accounts. So that is what we have micros for. There are micro contracts for all three of these, basically 1/10 of the value. So ES has micro ES, and then NQ, MNQ, GC, MGC. They're all worth 1/10 of the value of their parent contract, as you can see here. So say we went to that same trade on NQ, but it was actually just on MNQ. We had one MNQ contract. Go here, take a long, take a 20-point win. That is only $40, which means that you also risked less. So basically, MNQ is a lot safer than NQ because it's lower leverage, but you can also increase to more than one contract. So say I want to take a trade with 5 contracts, 5 MNQs, then that is half of one NQ still. So then that 20 point win would be worth $200 rather than $400, which also means that the risk was half. So micros, super important. I usually trade on MNQ, just depending on what trade I'm taking and how much risk I'm willing to put into it. Anywhere from like a few to like 8 micros. Just depends on your trading style and your strategy. But yeah, leverage is super important. If you have too high of leverage, that is, I think of it kind of like playing with fire, because you can sure make a lot of money faster, but also that's not great risk management if your leverage is too high, because you can also do a lot of damage to your account very quickly. So yeah, leverage and risk management go hand in hand directly, and I imagine we will talk a lot more about that later. But So we call them micros, and then we call these ones mini. E-mini, S&P 500 is ES, and then micro is MES. So just minis and micros. It's common terms you'll hear talking about contracts, um, especially between ES and MES and NQ and MNQ. So also, important thing to know, CME, you'll see in the background the watermark here, means Chicago Mercantile Exchange, which is essentially the home of the futures we trade. Just like the New York Stock Exchange is the home of stocks, the CME is the home of futures. That is simply just the physical location of where all of our any electronic live orders go. It's through the CME. And also something you'll see up here. If I go to ES right now, it says ESU6. That means it is ES third quarter of the year 2026. It's just something to know. Not extremely important, but contracts expire. These two index futures contracts last 3 months, meaning that they roll over 4 times a year. And then GC commodity product rolls over 12 times a year, so once a month. So yes, U6, July, right here. Yes, U6. So that's just something to know. And also a concept that you will probably hear. It's called full porting, which means that trading with maximum leverage, which is something you should not do. Basically, for example, if you have a account worth $50,000, your max contract size will probably be something like 5 minis, which is a lot. So say on NQ I went here with 5 minis. That is $100 per point. This trade right here would be worth like $2,000, which also means that your risk is pretty big. So that's something you definitely do not want to do. That is a lot closer to gambling than actual futures trading. So, like I said, that's like playing with fire. Just because you can doesn't mean you should. So, yeah, I think that's all I have for today. Just make sure you have a good understanding of this contract is worth this much per point over a year. And then also minis versus micros. The more contracts you have, the more leverage you have, the more exposure you have in the market. So size accordingly. But yeah, next video is talking about orders. That's with Lucas. We'll talk about market, limit, and stop orders. Basically the 3 orders we use when actually executing a trade. And then after that, we'll talk about prop firms, which is super important. Probably going to be a pretty long video to make sure you guys have a good understanding of the firms that we use. Pretty great resources. But yeah, see you guys in the next one.